Regarding Section 160 of the Income Tax Act, transferring assets, accounts, and income into the names of spouses, friends or colleagues, can pose a problem. Perhaps the most common example of tax debtor falling victim to Section 160 is the attempt to take his, or her name off the title of a jointly owned home in an effort to get out from under CRA collection action. Section 160 is a powerful, legislative-based collections authority granted to the Canada Revenue Agency. Section 160 is designed to attack property transfers between non-arm's-length parties, for example family members. Due to the mounting pressure for the CRA to collect on unpaid taxes quickly, Section 160 is becoming a more commonly utilized tool by CRA collectors. CRA's rights under Section 160 is that they can bring in this measure based on what they suspect. CRA does not need a court order to enforce going after both the original tax debtor and the beneficiary of the transfer. This puts both parties' assets at risk. Once you become aware that a tax problem is evident, or is sprung on you, and understand that potential action could be taken against you, you need to position yourself very carefully to come up with a realistic plan to deal with CRA. Consequently, this means that if a taxpayer is aware that a tax problem exists, and the taxpayer transfers assets to someone not at arm's length, the taxpayer is making the receiving person liable for their tax debt.
Don't you hate it when that happens to you? When it does, you need this and this and this. When it happens to me, I always know where to go. When you've got professionals on your side, your problems don't stand a chance. What are you waiting for? Contact them today and let them take care of your problems.